Okay.
Okay, awesome. So, thank you so much for coming to our closing time homebuyer happy hour. This is going to be a lot of information, so feel free to stop us at any time. Obviously, we don't expect you to memorize all of this, so we're going to send out a nice email after this with a recording and everything. Um, there's a ton to learn, and you'll never know it all. So, use this as a resource in the future, but at least for now, this will be a really good ground for your home buying knowledge. And
Perfect.
then I think I have, oh yeah, I was gonna say. Okay, so I'm Jesse Case. I am on the right. I am a mortgage lender. What that means is I do the boring financial part of the process, and I sell money essentially. So if you need a loan to buy a house, I'm your girl. We pretty much get you pre-approved. Once you go under contract, we take care of all the loan due diligence beforehand and after, and then work really closely together throughout the whole transaction. I am a native of Colorado, so I have been born, raised, never left here, still living here now. And so I'm super familiar with the area and been in lending for a few years now. So, yeah, that's a little bit about me.
All right. I am Bree Ortiz. I am a realtor and I live and serve in Northern Colorado. And one thing that I noticed too, before I get in too much into myself, is I had this on Eventbrite, and I think because it's virtual, I had it for Colorado, but I just was curious, where's everyone located? Because I think maybe there's some people from other states here. So the information that we are going to share today, a lot of it can be applied across states. It's, how to get pre-approved, things like that. So the big picture items aren't really going to change. Of course, we both live and serve in Colorado. If you are needing a realtor or lender in another state, just let us know and we can definitely vet one and find you a great realtor or lender. We have a great connection across the nation too. So that was one thing that I noticed and wanted to address. But again, I'm Bree and I've been a realtor for 5 years. Before getting into real estate, I was an elementary teacher. And so I think knowledge is so important. I think knowledge is power. When you are knowledgeable, you feel educated and informed and empowered to make the best decisions for you. And that way you're not just left, wondering, is this the right move? Things like that. So I really try and bring education into everything I do in my real estate business, and thus holding things like this. All right. So here's what you'll walk away with today. We are going to go over the home buying process, how to get pre-approved for a loan, various loan types. And again, these are like big picture things. No matter where you're located, it all kind of works the same. The average home buying timeline, home buying costs, components of a monthly mortgage payment, and then how to factor interest rates into your decision to buy. All right, so this is the roadmap map to home ownership. So a lot of clients will reach out to me first, and I love that. However, I do also refer them back to a lender. I think the most important and first step is just meeting with a mortgage professional to discuss your goals, like what your plans are, your timeline, what your monthly payment is that you feel comfortable with. So you'll meet with a mortgage professional and then have a consultation with them. During that, you will get pre-approved for your financing. And after that, you will meet with your real estate agent to discuss your goals, timeline, how the process works. So we're going to go over a bunch of things big picture today. And if you meet with Jesse or I, we will go over all of this again. You'll hear a lot of the same information twice. So don't feel like you have to take it all in. You'll hear it a whole bunch of times throughout the process when thinking about buying a home. Once you're pre-approved, once we've figured out what you're looking for, we will begin looking at homes that fit your criteria to find the one. And when you do find the one, we will make an offer and discuss various terms that you want to offer the seller. And then from there, so once you make an offer, your offer can be accepted. You can go back and counter or negotiate a few times with the sellers, or they can just deny it. But once your offer is accepted, you're now what we call under contract. And depending on where you live, some of these terms or some of these steps may look a little bit different, but here's how it looks in Colorado. Within the first week, you will get an inspection scheduled, and then that is your time to negotiate repairs or credits instead of repairs with the homeowner. Your lender will order an appraisal once we get past the inspection. And an appraisal makes sure that the home is valued at the price you're offering. So that way you're not overpaying on a house. You will find and set up homeowners insurance and make sure that you can find a quote that encompasses all the coverage you want at an acceptable rate. And then your loan will be submitted to underwriting. And during this time, it could be, during inspection, appraisal, throughout this process, your lender may be asking for additional documents and things like that for you. Jesse, is there anything you wanted to talk about for the loan aspect?
No, I think a big well, not misconception, but something important to know is that like the lender has a big part at the very beginning. And then sometimes there's, between when you meet with your real estate agent and all the time between, people think that the lender is kind of not there, which is kind of true. However, when it comes to payment scenarios and all those things, like there is a spot for the lender the whole time. However, my part really, really, really comes in after you're under contract. So you'll see that like a lender is heavy on the due diligence at the beginning and then more heavy on the due diligence in the end, and somewhere in between is where um, you kind of just keep in touch and then work with your realtor more and things like that. So as far as timeline goes, we work as a team the entire time. However, it gets a little blocky with where things are more prominent, I would say. That's
Yeah,
it.
I will say as we're looking at homes and anytime there's a home that you think, oh, maybe this is the one, even if it's just a maybe, or I kind of like this, I always suggest, yeah, talk to your lender, ask them what your monthly mortgage payment breakdown will look like. So that's where I refer back to the lender a lot, even
Mhm.
while we're home searching, just so you can make sure that the payment estimate is affordable and it's comfortable to you before making an offer on the house. Um, then, once your loan is approved, we work with the title company. Colorado uses a title company to conduct the closing. We finalize figures that are owed and need to be brought to the closing table. And then we have closing day, which is where you sign your deed, you sign all of your paperwork to take ownership of the home, and then you're officially a homeowner. So, really exciting stuff. Okay.
Okay, so the pre-approval process. First of all, what the heck is a pre-approval? A pre-approval is really like your preliminary process of a lender that's reviewing your finances to see what you can afford on paper. Um, and why is that important? The benefits of that are, first of all, you're able to write a strong offer. Having a pre-approval letter and knowing that you've done that due diligence up front is really, really important to any listing agent when you're writing an offer, showing that you're serious, first of all, but that also if they take their house off of the market, that you can afford this house and it's not going to fall out later. So that's one benefit. The next thing is that you're prepared when the right home comes along. So kind of like Bree was saying earlier, during the process of the home search and all that, you will be in contact. Well, we will all be in contact together, essentially making sure that not only does the home fit your lifestyle and what you need and your family and all that, but it also fits your finances. And so you would know what to kind of be looking for in your price range in that specific scenario. Another benefit of getting pre-approved is that you have time for credit repair. So if there's anything that were to come up on your credit report, if there was something that we could enhance on your credit, let's say all those kinds of things, sometimes that takes time. And it's better to be able to do that up front and know that you have time while you're searching for the home, than go under contract and have to try to do all that in reverse. And then the last thing is that you and your realtor have a better idea of what you can afford. So kind of what I was just saying, but there's really no reason. We like to set expectations up front so that you're not looking at $1 million houses when you're really only comfortable paying or can afford a $500,000 house. That's gonna set you back pretty far. So it's really good to get that pre-approval number up front so you know where to go with your home search from there. My pre-approval process is super straightforward. The first thing is unfreeze your credit if it's frozen. Some people do this, some people don't, but it will need to be unfrozen to be able to pull your credit. So first things first there. And then after that, you would fill out a loan application. This is like a standard credit application that you've done anytime you've had someone pull your credit. It takes 10 to 15 minutes. Who are you? What do you do for work? Where do you live? Kind of thing. After we receive your application, then you give me a bunch of documentation. And sometimes this is the daunting part because you have to go back and dig up your W-2s and your pay stubs and bank statements and all the kinds of things that you put on that loan application. You have to prove to me in documentation. So after you get me all the documentation, it takes my team 1 to 2 business days to kind of put your file together. So that's the actual pre-approval part of it. And then we would schedule a Zoom meeting to do this again, a lot of home buyer education, talk about the programs that you qualify for, where you sit financially, what your comfortable payment is versus there's what you're comfortable with and there's what the computer says. So where, are we overlapping there or um are we needing to reset expectations, all those kinds of things. So, and in that time, that's where we will obviously answer any questions, do a lot more education, and kind of give you the green light essentially to go house shopping. Did I see a chat that said question?
Oh yeah, please do. I can't see the chat, so
Yeah.
yeah, please interrupt whenever there's anything in there.
But thank you, thank you, Jesse. If I'm saying the name right, Jesse, right?
Yeah. Uh-huh.
Yeah, yeah. So yeah, I had a question about the pre-approval process. I was
Yeah.
wondering, uh, so when we get the pre-approval letter, how long that letter is valid for?
So the letter is valid for 90 days, and that's because your credit report expires after 90 days. However, I always tell people if even though your pre-approval letter says it expires in 90 days, I still have your loan application. I still have all your information. You don't have to restart anything at that point. That's just where we would have to re-update your credit and your documents. So it's
Okay,
not like you have 90 days to buy a house and you're done, or you have to go find another lender. It's not like that. It's really valid for as long as you want, as long as we're keeping in touch and nothing big has changed. As long as your cash, your assets, your credit, and your income haven't changed all that much, your pre-approval still stays valid for as long as we need.
great. Thank
We
you.
would just update the pre-approval letter at that point. Mhm.
Yeah, I have one small complaint. You mentioned something about everybody brings their own drinks. I'm not seeing any drinks on the table. I actually brought one. I
Did you?
had one.
I love it. I
That
love
looks good.
I
Yeah,
know
it's
I'm
I
actually
enjoying.
I
yeah.
have a water, but yes, I did not come very prepared. I am pregnant, so it would have to be a mocktail, but I should have at least brought seltzer water or something.
Yeah, I put some tequila in my orange soda.
Oh, I'm jealous. I'm jealous.
I love
I'm
it.
going
Oh
to
my
take a
gosh.
sip now. I haven't taken a sip yet. I was waiting. Everybody, maybe we can do cheers. And I was thinking, and no, I thought everybody's gonna take a sip together. Sorry for that. Yeah.
Oh,
Yeah, yeah, that's
we're
that's a great idea. Well, I don't know that I can see. Hang on, I gotta adjust this. All right, well, here we can do a cheers here. Cheers.
Cheers,
Got a
guys.
water?
Cheers.
Here
Cheers.
you go. Here you go. Cheers.
All right.
All
I'm ready for
right.
the next slide.
Perfect. Okay, let me minimize that.
Okay. So as far as credit, things kind of to do and not to do after your credit has been pulled, or maybe before if you are thinking about buying a house soon. So there's a few things. Your credit score goes up and down depending on a lot of things. And you'll see on the left here, there's a graph that shows kind of the main reasons that your credit goes up or down and the small reasons that goes up or down. The five things that I always stress to buyers is one, minimize the amount of times your credit is checked. Don't get your credit pulled a bunch of times because every single time you do that, it does hit your credit. So it makes your credit go down every single time. The next thing is pay your debts on time. If you are late on anything, it's going to hurt your credit by sometimes hundreds of points. Something that we've been seeing quite often is student loans. If you have student loans that have been deferred, and then all of a sudden they're back on track and they're back on, the Department of Education doesn't do a great job of telling people that they're starting again. And so if you even miss one or two payments and you don't know about it, it can hurt your credit by hundreds of points. So just make sure that you know the debts you're paying and make sure you're paying them on time. That's probably the biggest thing. The third thing is negotiate any settlements with creditors. So if you have any outstanding debts that are, due and still sitting on your credit report, make sure you negotiate a settlement with them. It will help in the long run, and then it'll fall off your credit report eventually. The fourth thing, fix any errors on your credit report. Obviously, we only want things on your credit report that are yours and that match what you have done with your credit. So we need to make sure that everything's accurate there. And then five is avoid large purchases on current credit cards. So don't rack up big purchases after we've already pulled your credit. It can make your credit score go up and down a lot. One thing that I really want to stress, and that I've been running into a lot lately, is people trying to fix their credit before talking to a lender. And that is great. I will never I would never shame anyone for trying to fix their credit or paying things off. However, there are certain things and it's credit, there's really no rhyme or reason to it sometimes. Like sometimes if you pay off an old collection, it actually reignites that account and so it hurts your credit a little bit. So I think it's really important to talk to your lender about credit if you're worried about it at all up front, because lenders have simulators and things like that. They can tell you exactly what to do right then, and then you're not doing things that you think are helping and are actually hurting. So anything with credit, it's better to get with a lender earlier than later.
I have a,
That's it. Oh yeah. Question?
yeah, I had a question. Can we
Yeah.
go back to the previous slide?
Yep.
Yeah, so the number five, the fifth point you mentioned that avoid large purchases on credit cards, right? So let's say if you decide to buy a car, but car doesn't use the credit cards, like you take a car loan. So is that okay, or is that also doesn't fly?
No, definitely no large hits on your credit. So
Oh,
if you
okay,
were to buy
on the
a car,
credit, not on the
that hurts
credit
number
card.
one.
Okay.
Yeah, the credit that doesn't have anything to do with the credit card necessarily, but that does hit number one. If your credit's checked by a credit or by a car company, it's going to hit your credit. On top of that, you're going to have different utilization, you're going to have more debt, all those kinds of things. So the list kind of goes on. On top of that, you're going to add a large chunk of debt to your debt to income ratio, which is what we base everything on, which is the amount of debt you have monthly versus the amount of income you have monthly. So we want as little debt as possible. It doesn't mean that you can't have some, but a car payment would definitely be a significant hit on your credit.
Okay, sounds good. Thank you.
Yeah.
And
But if
just
you were to have to do that, that's where I would say just talk to your lender. If you've already been pre-approved, that's something that you would want to ask your lender about to make sure that your pre-approval still sits within a certain range and that they can know that that's going to pop up on your credit. The worst thing would be to be under contract on a house and then to buy a car, because then you might not qualify for that loan anymore and you can't get that house. So that's where in the home buying process, you have to be really, really careful with what you buy and what you do with your credit.
And Jesse, I know you have a whole list of things. Like I know another thing is not to change jobs during this time as well. Do you want to go
Yeah.
over that? And then we can send that. I'm going to send this recording in an email and we can send some of that again, just so you have that because it's not in the
Yes.
presentation.
So a couple other things. Yes, don't change jobs in the middle of the pre-approval process. Everything we're doing is documented based on then and there. So if you have one job and your income is something, and then you change jobs and your income is still similar, but it's reporting differently, it can still completely change your approval. So you still need to make sure that regardless of income and all those things, that you don't change jobs in the middle of anything, especially after you're under contract. That's the biggest thing. Once you go under contract on a house, nothing can change with cash credit or income. So definitely no changing jobs. Another thing is no large deposits or withdrawals out of your accounts. If you have $5,000, let's say, coming into one of your accounts that we have to see the bank statement for, we're going to have to trace that back. There's a lot of laws with lending about money laundering and things like that. And so any big purchases, any big amounts of money going out of your account has to be, there has to be a paper trail of that. And so it makes things complicated and it could mess up what you qualify for very easily. Um, so yeah, like I said, anything with cash, credit, or income don't change once you're in the pre-approval process unless you confide in a lender first. Is there anything I'm missing there, Bree? I feel like
No,
that's
I
the
think
main.
you covered all the major ones that come to
Okay.
mind for me.
Me too. Okay. So there's lots of types of loans. There's four traditional types of loans. First of all, I'm going to start from the bottom. So there's a USDA loan. USDA is a loan for home buyers in rural areas. So kind of out in the boonies a little bit. You can put 0% down on those. They have no mortgage insurance. They're great loans, but they're kind of hard to qualify for, I will say. So there's a lot of income limits. There's all kinds of things, location things. You don't see USDA loans as often as you would see a conventional or an FHA loan, but it's also a great loan and it's backed by the U.S. Department of Agriculture. So um, it's an option if you qualify for it and you can find a house that also qualifies for it. There's a VA loan, which is for veterans. If you're a veteran, you can use a VA loan. That's one of the best benefits of being a veteran. If you're not, then you can just X-nay this one off the list. You have to be able to even use that. But essentially, it's a 0% down payment, a great loan, great rates, all the things. Probably one of the best loans that you can get. And then our two most common loans are conventional and FHA. So an FHA loan is commonly issued to first-time homebuyers. But that's because it's low down payment, 3.5% down. You're able to have a little bit more debt with that loan and a little bit worse credit. A lot of times with first-time homebuyers, we see not that they did anything bad with their credit, but that they just have baby credit. Like they haven't had credit for that long, so they haven't had time to get it super, super high. That's where we would put someone in an FHA loan. And those are great loans. Then there's a conventional loan, I would say is like our kind of A plus loan. These are for people who don't have a lot of debt, have great credit, have good income, have a sufficient down payment. What I will say about a conventional loan is that as a first-time home buyer, you can put as little as 3% down. So that's a huge benefit of being a first-time home buyer for conventional. However, if you put less than 20% down on a conventional loan, you will have mortgage insurance. What is mortgage insurance? It is pretty much it's insurance to protect your lender in case you were to go delinquent on your loan and decide that you don't want to pay your mortgage payments anymore. It helps pay the lender back essentially. So it's kind of based on a risk factor saying the higher your credit score is and the higher down payment you have, the lower your mortgage insurance is every single month. So, and then it goes, the other way too. If you have really low credit and you have a 3% down payment, your mortgage insurance is going to be significantly higher. However, on a conventional loan, eventually that mortgage insurance falls off. You don't have to pay that anymore. It becomes not a part of your mortgage after you have 20% equity. Huge benefit of it. And then FHA, on the other hand, has lifetime mortgage insurance. That's kind of part of FHA being a little bit riskier loan anyway. Um, so they have two types of mortgage insurance, upfront and monthly. The upfront can go right into the loan, so you don't really have to worry about that much. And then the monthly is obviously monthly. Unless you put 10% down, then it will fall off in 11 years. So there's some caveats there. We won't get too into the weeds, but know that conventional FHA, VA, and USDA are our most common loans. And those are the kind of things that after you do your pre-approval, we will fit you into exactly the boxes that you qualify for and talk about all those things and your options and where that puts you month to month. Um, the other thing that I want to bring up is a program that we have in Colorado specifically. Every state has something similar, I believe, but it's a down payment assistance program. And so what that means is that they give you, for example, the Chaffel one is 4% of your loan amount in the form of a second mortgage. We call it a silent second because it's at 0% interest and you make no monthly payments on it. The only time you have to repay that loan is if you sell the house, refinance the house, or you pay off the loan in 30 years. So that would be hoping that your equity would pay off your down payment and you'd never come out of pocket once. There's a few little nuances in there, but we won't get into the weeds of that right now. Just know that you don't necessarily have to have 3% down up front to be able to buy a home. There's options there. That one was a lot.
You just had up like three heavy slides in a row. So,
Yeah.
okay, that was the pre-approval process. Now I want to go big picture and just talk about the home buying timeline overall. So I like to work backwards. So think about when your lease is up or whenever you want to be out of, maybe you're not even renting if you are a homeowner, when you want to be out of your house and into your new home, and then work backwards. Overall, I'd say it is about 3 to 4 months on average from the time you're pre-approved. So the pre-approval process, that can be as quick as 24 hours or it can take up to a week. The discrepancy there is really just how quick you are in turning in your documentation to your lender. So I think that's what changes the time on that one. Once you're pre-approved, you begin house hunting, and that can be some buyers will go out and find their home that week that they want to make an offer on and purchase. Others, I'd say, can take up to three months on average. And then when you find a house that you love, you will make an offer. And so the time of making an offer and then acceptance and or your negotiation period is anywhere from 1 to 3 days on average. Once you're under contract in Colorado, we say you're in your due diligence period, you're under contract on a home. That's where you get your inspection, your appraisal, you check out your homeowner's insurance, all of those things. And typically it's 30 days, 30 to 45 days is pretty common. 30 days is the most common if you don't have another house to sell or anything like that. And then last step is closing on your home. And again, it's the overall process for my average buyer is 3 to 4 months from the time we sit down, have a consultation, and the time they get pre-approved. So one of my most common questions is making an offer. What happens when you're ready? What does it look like to make an offer? And this is something your agent will do for you. So once you found the one, here's the next steps that we do. First, I will send you comps to make sure that the list price makes sense. And then the price that you want to offer is competitive with homes that have sold recently. Every market is a little bit different. Homes in Colorado are going, it depends on the neighborhood, anywhere from 96 to 99% of the list price. So, and there's deals that can be had in this market. It's just looking in the right places. Those are things we can go over in a consultation. But overall, we review comps of recently sold homes to make sure pricing is competitive. And then we decide on terms that you want to offer. And so many things are negotiable in a contract, such as items you want to stay or leave in a house, the price, of course, the timelines that you want to have your inspection, your closing date timeline. So we will go over all of those terms. And then with that, I will walk you through the contract. It's a lot of lawyer jargon. So it's definitely, if you're not looking at it every day or if you're not an attorney, I think it's can be intimidating to go through and to understand what it means. So that's something I will walk you through the contract so you know what you're signing. And then I will submit the offer to the listing agent. And one of the biggest things I think makes a difference is just strong communication with that listing agent. And that even starts from the time we leave the showing and saying, hey, I have a buyer who's interested in your home. Please keep me updated if anything changes on your house, if you get offers. So just communication with the listing agent is so important throughout the whole process. And then once you do submit that offer, and once we submit it to the listing agent, they will give it to the sellers. And the sellers can either accept the offer as is, they can counter and we can negotiate terms, or they can just reject it. And then finally, once it's accepted, you're under contract and the next phase of inspections, appraisal, all of that documentation begins. So what makes a strong offer, especially in this market? I will say overall, I think overall nationwide, it's a balanced market technically in most cities and states, and Colorado included. In Colorado, it's definitely, I think, leans a little bit buyer heavy towards the buyer's market. rather than a balanced market just because of the amount of options that buyers have. Some homes are still going quickly, under contract within the first week. A lot of homes are sitting, the average where we live right now is 45 days. So anywhere from a month to 60 days, a home will sit on the market before getting an offer, and that's really common too. So what makes a strong offer and makes a seller want to accept your offer? We've talked about this. It's having a pre-approval in hand, offering a competitive price. I think there's deals that definitely can be had. It's looking in the right places, and there are some signs that sellers will give, such as dropping the price really quickly, once listing that they are eager to sell. So there's some of those things, and just conversations with the listing agent to find out the seller's motivations. So offering a competitive price, flexible timelines that work for the seller. Sometimes I will say if we're gonna, go lower on price, maybe we do a quicker closing. So that way sellers will be more inclined to accept the offer. You have to deposit something called an earnest money deposit in Colorado. That's what we use, and that's a deposit on the house that shows you're serious. I will get into more details. It might not be the next slide, but in a slide or two about that. And then, of course, sellers always prefer offers that have fewer contingencies. And what that means is such as not having to sell a current home before you purchase the next home. So if you don't have to sell a home, that's even better. And then I went over this a little bit a few minutes ago, but just strong communication between the agents makes a huge difference. I've had in a competitive market, I've had buyers who've won the home and their offer was selected in a multiple offer situation, even if their offer was not the highest, just because of communication that I kept up with the agent. So who you work with matters, and that's definitely something that is important as well. Okay, here I'm going to go over a little bit more of the earnest money and other upfront costs that you can expect. This will vary, costs, and the quotes that I give might vary state to state. So this is mostly for Colorado. Costs will probably stay the same as far as, each of these categories. It might be worded differently where you live, and the costs in itself might change. But here's kind of general categories you can expect when purchasing a home. So the first thing is earnest money. And so that's a deposit on the home. In Colorado, it's typically due within 2 days of going under contract. And it just shows the sellers that you're serious about their home, that you're not going to make an offer and then walk away, 2 weeks into it and have no skin in the game, basically. So these funds, they do go towards your down payment. So if you're giving $5,000 in earnest money, it's $5,000 less you need to bring at the closing table with your down payment. So it just gets taken out of there. And then typically we see it's about 1% of the purchase price. Again, that's a Colorado specific stat. I don't know if it's the same 1% in other states. Then within 7 to 14 days, I would say, of going under contract, you will get an inspection done on the home, or I highly advise you get one done. And so in Colorado, the cost of a general inspection is $500 to $600. And then this is Colorado specific, but in Colorado, I say you should also get a radon test. And radon is an odorless gas that's in the soil in Colorado, especially because we have basements. It rises up, and there's a high radon uh, level in most Colorado basements, and it can cause lung cancer. So I suggest a radon test to get that mitigated, and then a sewer scope, because sewer repairs are so expensive and costly. And we just want to make sure that that's not something you get stuck with and had no idea about once you purchase the house. Each of those costs in Colorado is 150 each. So in Colorado, I say for an inspection, I always tell sellers plan to spend around $800. If you are seeing a house and you have concerns like mold or something like that, there's additional tests that you can get done. If you think it's a home needs more than those, I would say just plan upwards of around plan around $1,000 if there's other tests that you think you want to add on. So that's the inspection. Then closing costs. Your lender has fees for working the loan, and same with the title company for doing the closing. And those typically range from 2 to 3% of your loan amount. It does include things like an appraisal, title fees for pulling all the paperwork. If there's an HOA, it includes like transfer fees and just random HOA fees. Um, and one thing you can do, especially in this market, is have ask for sellers to pay those closing costs. You can ask for all of it or ask them to pay for a portion of it. That's something sellers are really open to right now in this market. And then finally, the final fee, this is something I wanted to put on there. Each person I feel like follows the news about this a little differently. Some people have no idea, some people have with the NAR, the National Association of Realtors settlement. So sellers historically have always found it in their best interest to pay a buyer's agent fee. And since the settlement happened a year ago, that has not really changed in Colorado. If a buyer comes to them, a seller, and has to bring a down payment, pay for closing costs, and pay for a realtor fee, that all those fees really add up and will limit the buyer pool who is looking at their home and who can afford their home. So sellers, especially in this market with homes taking longer to sell, they want as many buyers as possible to afford their home and seriously consider it. So each seller historically, and it's been the same here in Colorado, sellers are paying agent fees typically. It can be a combination of things, though, that I do want to point out. As a buyer, if you are hiring a realtor, that is something that you need to know. You are the one hiring them. So it can be the seller will pay, you both can pay a portion, or, the buyer sometimes can choose to pay all of the agent fees too. So that is something that I did want to at least cover as well.
I had a question. Can I ask
Yeah, absolutely.
about the home inspection? So
Uh-huh.
we were talking about that, and you mentioned that home inspection could take $500 to $800. And let's say if something sounds really wrong in the house, maybe the ceiling has a
Yeah.
leaks or cracks or anything like that. So we are not going to go with that. So what happened to the money we have already paid to the inspector? Does that get refunded by somebody or is it gone?
That's a great question. It is gone. So when you have a home inspection, you can ask for the sellers to make repairs, and that can include, I've had an issue where I was selling a house and there was a leak in the bathtub that the inspector found. So the buyers wanted to make sure that there was no mold, rightfully so. And they pulled back where it was leaking and there was mold. So these sellers had to completely take the bathroom down to the studs basically and then redo the whole bathroom. So the sellers did that all at their own cost for the buyers. So there are situations like that. If you found a leaky ceiling and then it had issues like that, you can ask for sellers to make all the repairs. If you don't want them to make repairs, you can ask for money, and it doesn't have to be a leaky roof. It could be anything. Say, I would just rather have money for this, a credit for it, like carpet. Like, I want to pick my own carpet. I don't want you to pick it. Please just give me the cost for it. You can ask them for repair for credits. Or, yes, if we can't come to an agreement, or if you just don't want to ask a seller for any repair, say this is too much work, I don't even want to move forward with this house. You do in Colorado, you do have a deadline where you can walk away, and you get your earnest money back. So all of your deadlines protect you to leave with your earnest money intact. However, if you choose to leave and you do pay for a home inspection, that is just unfortunately a cost that's eaten up. So that's why I say we do want to make sure that, I think if you're working with me, this at least is something I know that I do. If I'm walking through a house with you and I'm noticing concerns such as, oh, like there's water stains on the ceiling, or oh, in Colorado we have it's expansive soil. So, oh, there's like these cracks. This one looks more serious than just what we typically see. I will point those out. So that way you have kind of a heads up before making an offer. and can kind of consider those things and weigh that and see if it's something you want to move forward with. You can kind of weigh those into your purchase or offer price. And so that's why, it's just kind of doing a little bit of work and maybe even seeing the house a couple times before you make an offer to make sure that it's something you think you would want to move forward with and not just do inspections on any old house just because of course that adds up and gets very expensive.
Thanks, I got it.
Yeah, absolutely.
Okay, what goes into a monthly mortgage payment? I think this always catches people by surprise a little bit because there's a lot of pieces to it. So it's not like a car payment where you go buy a car and you borrow the amount of money that the car is worth and you pay the interest on it, and that's all you pay every single month. There is that part of the payment. That's called the principal and interest. That's the amount of money you borrow at the interest rate you borrow it at. That is the part of your loan that will stay fixed for 30 years, 360 payments. That will never change unless you were to refinance or something along the road. That's going to be the base of your loan, the meat and potatoes of the loan. And then we have what we call an escrow account. An escrow account is, think of it as like a mini savings account, and it has two different buckets. What happens in Colorado is you have property tax, and property tax is due 2 times per year. That varies state to state, but it's typically 1 to 2 times per year. And then homeowners insurance is required by the lender, and you pay that 1 time per year on the day of closing every single year. And what happens is those things are due, and they're due in large lump sums of money. And so as the lender, we take it into our own hands. And what we do is we prorate your taxes and your homeowner's insurance into monthly payments. So you can see if it's a $1,200 a year tax payment versus a $12,000 a year tax payment. That's either $1,000 a month or $100 a month, and that can sway things a lot. However, we prorate them into month by month, and then we just make it part of your mortgage payment. You pay into that escrow account, that mini savings account every single month. And then when those things become due, we pay it on your behalf so that we know it's being paid, we know it's been saved for, and then it's paid on time. And the reason we do that is because if like taxes, let's say taxes can become a first lien on the property if they are not paid. And so that's a threat to us as the lender if we're like, no, we don't want something to take over the first lien on the property, essentially. That's how we protect ourselves and protect you. It's good for you too, so that you don't have to save up and come up with like thousands of dollars all at once every single year on time. So that's what we call an escrow account. That's the part of your payment that can change. So even though you're in a 30-year fixed mortgage, the fixed part is the principal and interest. The escrow account can change, and that's because property taxes go up or down, hopefully down, but we don't see that very often. And homeowners insurance also changes. You are free to shop your homeowners insurance at any point of any year, but property taxes just kind of are what they are. You can appeal them, but on the other side of things, you kind of want to see your taxes rise a little bit because that means your house is appreciating. And they will. They'll go up in the life of the loan. So you'll see that your mortgage payment will adjust over the life of the loan. However, at closing, we do cushion those savings accounts a little bit so that if your payment goes up just a tiny bit, that hopefully we don't have to change your monthly payment at all, and we can just use the savings in there to kind of make up for that for a little bit. So those are kind of the two main parts of the mortgage. And then, like we kind of talked about earlier, there's what we call mortgage insurance. That's the insurance to protect the lender. And like I said earlier, that's dependent on credit and down payment. The higher those two things are, the more, or the lower that is. Sorry, the higher credit is, the higher down payment is, the lower your mortgage insurance is. And that's also part of your mortgage payment. So when you make that one lump sum of mortgage payment, that gets paid, taxes get paid, homeowners insurance gets paid, principal and interest get paid, but you only have to make one payment. The cool thing about mortgage insurance, if you do get to be in a conventional loan, is that eventually that mortgage insurance will fall off and you won't have that anymore. So hopefully at that point, your mortgage payment goes down. Once you hit 20% equity in your property, you no longer have to have mortgage insurance because we don't, as the lender, don't see that as much of a threat anymore, kind of thing. So you'll see that all all those things making up a mortgage payment, there's kind of a lot to it when it comes to a pre-approval. And the reason being is because we do everything based on monthly income and monthly debt and kind of the difference between those two and the percentages. So if you, sorry, we find a monthly payment that you're approved for, and then we back into the purchase price, and that's the number that you get pre-approved for. However, depending on the property, depending on taxes, 'cause taxes vary from property to property, not even like area to area sometimes. So your next door neighbor could have $12,000 in taxes and you could have $1,200 in taxes. And you'll see that you might be approved for 350,000, but if you have $1,000 in taxes a month, you're not going to be approved for $350,000 anymore. Those things kind of sway your payment a lot, which is why during the home buying process, that's where or the home searching process, we keep in really good touch so that you can use me as a resource to tell you kind of, okay, this is where this one sits and this is where this one sits. No payment is going to look the same on if you buy a $350,000 house over here, your payment is probably not going to look the same as the $350,000 house down the road. There's kind of a lot of factors that go into that. So the last thing I want to mention that I almost forgot is HOA. So HOA is not a part of your mortgage payment. You will pay your HOA directly to the HOA association every single month. However, we do have to keep it in mind for your pre-approval. You still have to be pre-approved for the entire housing expense, and that includes HOA. So it's something that we have to make sure that we're looking at in your pre-approval process too, if you were to be looking at a condo or something. And that kind of leads me into the next slide, Bree. So there's different types of properties, single family, which is your normal house, and your townhome, which is attached, and then your condo, which is a condo, like an apartment building kind of thing. The main thing I want to point out between these three types of properties is that your pre-approval is going to look very different depending on the property. And that's because of what we were just talking about with HOAs and with taxes. You'll see that like a condo is most likely going to have an HOA on it. So your pre-approval is going to be a little less, but that's your pre-approval purchase price is going to be a little less, but that's because we have to think about that HOA that's making up that extra cushion versus a single family home, which typically don't have HOAs. So we can just assume your taxes, assume your homeowner's insurance, and kind of go from there. So you'll see that, and then townhome is somewhere in between. Sometimes those have HOAs, sometimes they don't. But like I said, depending on the type of property, there's kind of a big difference in pre-approval. The other thing I want to say about condos is that even though there's typically an HOA on them, the homeowner's insurance that you have to get is typically a lot cheaper because you only have to insure your four walls and what's in between. You don't have to insure the entire exterior. That's what the HOA insures. So that's usually all encompassing in that HOA. I say usually because you just never know, but that's pretty typical for condos. So there's some give and takes there, but that's why it's really important to kind of narrow down what you're looking for up front to make sure that your pre-approval stays accurate the whole time you're searching. Anything you want to add to that, Bree?
I don't think so. I think you covered it really well.
Okay, sweet. Okay, really quick on this slide. Waiting versus not waiting, especially in the media today, you're seeing a lot of people say, I'm waiting for interest rates to go down. I'm waiting for interest rates to go down. And that's totally fair. Interest rates do seem high right now. It's expensive. It's hard to be a first-time home buyer, truly. However, there are benefits to having higher rates. And the reason we say that is because the housing market, just like anything, is supply and demand. And when there's a lot of demand, things are a lot more expensive and vice versa. So in turn, when rates are really high, people are scared. There's not as many buyers in the market, meaning that buyers have a lot more power. So that's where you see things like right now, where we're seeing houses sit on the market a lot longer, and then buyers are like, hey, I want you to pay for my closing costs. I want to close 60 days out, all the things, anything that could be enticing to a buyer is becoming more of a conversation versus the latter, where it's like interest rates go down into the fives, let's say. They actually do, there's a stat, and I'm going to botch this, but it says something like Every 0.5% that the rates go down, like 5 million people enter the market. So to kind of go on top of what I was just saying then is when rates get lower, things sell faster because people are excited. Things are more affordable, except that they're not necessarily more affordable because what happens is more competition. And so instead of kind of getting what you want as a buyer and then potentially refinancing down the road into a lower rate once you already have that house, what happens then what we see is people are doing quick closes. They're not getting seller concessions because there's multiple offers on a property all of a sudden. And so, yeah, we have low rates. That's great. But then people are buying houses for more than they're worth because they're competing up and up and up. So there's a lot of things that go into that, but the main thing is supply and demand and the cost of waiting versus not waiting. And the other thing that I want to say is this image on this on the left side kind of shows. So you'll see that on like a $500,000 purchase price with 7% interest rate, your mortgage payment, and this is yeah, your mortgage payment is around $3,300. Well, while you're waiting for the rates to go down 0.5%, which seems great. Like 7 versus 6.5 sounds scary. It does. But in the time you're waiting, that house is also appreciating. People are also entering the market more. All of a sudden, the purchase price of that same house is 550, but you have a 0.5% lower rate. Like, oh, I waited for that lower rate. Well, look at your mortgage payment. It's actually still higher. That with a 0.5% less interest rate and a higher purchase price, your payment is higher. So I think that's a big misconception in the world of like the right time to buy is when you're ready to buy, not when you're trying to time the market. It's not about timing the market, it's about time in the market, and backing into the purchase price that works for you. But know that everything in this world is appreciating while you're waiting as well. So there's pros and cons of everything. That's all I got for that one.
Wonderful. So this is wrapping up our presentation. I just want to thank you for your time. If you are not ready to buy, here's how we can still work together. We can, for me and myself, we can create a home buying game plan, and that includes, is it Vicus? Am I saying that right?
Nobody said it right.
Okay, how do you
If
say
you
it?
would have said it right, I would have, probably, yeah, send Venmo you $100 or something if you would have.
How do you say your name?
Vikas, Vikas.
Vikas.
Yes.
Okay, I love that. So where do you live right now?
Actually, I got a job in Denver. That's the reason I joined this one. So,
Awesome. Okay,
uh,
great.
yeah, I'm thinking to move there. So, I,
Wonderful. Oh, go ahead.
no, no, go ahead. Go ahead. Yes.
I was just gonna say when it was on Eventbrite, I think because it got posted as, I mean, I put the cities in there, but with it virtually, I think there were also other people. I did a selling class over the weekend, and some other people from other states joined. So I just was, yeah, was just curious. So then I guess yes, everything then that I mentioned today does apply and would apply to you if you choose to buy a home here. When and if you are ready, I would love to sit down and we can just come up with your timeline, your goals, what you're looking for. In the meantime, though, I do send out emails pretty often, weekly, but once a month is like a market update email. Some people, like more stats. And then if that's not your forte, I do also put like local events, things to do, local guides, things like that. So that's something one of my passions is just like going out and doing things and community events and stuff like that, finding fun things to do. So I always love sharing that. And then if you have social media, I mean, I have like a business page on Facebook, but I'm mostly on Instagram at Bree Ortiz Realtor if you want to be friends.
Oh,
Love
yes.
it.
Yeah. I'm on Instagram too. Yeah. I
Awesome.
can add you.
I hope you add us. And Jesse, go ahead with yours.
Yeah, so I'm similar. I would love to start the pre-approval process or even just a plan. A lot of the people that I meet with, even if they're not ready for a year, we still meet and we still plan out what we need to plan out. So you never know the bumps in the road that are going to happen. It's always great to put a plan together, a financial plan, get everything kind of set up. Or if you're ready, then obviously get a pre-approval rolling too. So would be happy to do that. And then if you're not ready for that, like Bree said, I'm very similar. Market update emails, put you in the database and give you some updates there. And then local events and newsletters you'll see from me. And then on top of that, I'm pretty active on social media at Mortgages with Jesse. So that's the best way to kind of keep in touch with me and me keep in touch with you if you want to give me a follow. So, but yeah, thank you so much for coming. It's so nice to meet you. Is it Vikas? Am I saying it right?
Yeah, you got it right. Okay. Jesse, I have a question for you. I probably had to do more follow-up with you offline because those numbers, some of the number didn't make sense to me. There's just too many
Yeah.
number, and there is a bit of tequila in my drink, so
Right.
it meant some of the number didn't make much sense to me all the time. Maybe when I'm more
That's
sober tomorrow or day after, I'll probably send you a message and maybe we can chat more on the numbers. Because there are
You're
too
not
many insurance, there is too many fees, too many insurance, there are too many components to and those numbers.
Totally. And
right.
we are going through everything so quickly in this too, just to fit it all in. Like I said, it's kind of like drinking from a fire hose. So I will send the
Mm,
recording, if that's helpful. But then yes, please reach out to Jesse if you have more information, more questions about the
awesome.
information. We will both, I think, send an email. I will at least definitely send an email. You have everyone's information, Jesse. And Jesse, yeah, with our contact. So if you want to get in touch with either one of us, things like that too.
Mhm.
So
Yeah.
We'll do that.
And
Yeah,
we'll dumb
thank
it
you.
down a lot more when we can go a little slower and all that stuff too, and make it really personalized to you. Today was very broad, so I can understand why it would be really confusing, but
I
we'll
just
break it
didn't
down.
realize I'm the only one in this meeting. So I'm having like a personal one-to-one with you guys. I didn't realize that.
yeah,
I
this
was
is
thinking why no one is speaking and why no one is asking questions. And I just saw that it's nobody else is there in the meeting. I saw one person is on
We
mute,
should have
but
just
then I saw his same name.
we should have just got you pre-approved and just done
I know,
a
just gonna just
just
start
done a
with the
buyer consult
pre-approval.
with
Yep,
all of us.
fine. I didn't even know. Yeah,
Too
awesome.
funny.
well,
Yeah.
are you excited for your new job then?
I actually am, but I wanted to attend this event to know what are the home prices over there because I don't want to do, because usually the recruiter and the employer who hires you, they paint a very rosy picture, because they want you to join. But
Hmm.
they want you to make the move. But I want to do my due diligence
Yeah.
before I make the move, in case, you accept an offer and then you go there and you become like house poor, you can't afford anything. Because Michigan is
Very
very,
true.
I live currently in Michigan, so because Michigan is very affordable, it's not a very
Hmm.
high expensive city. It's like the typical Rust Belt, Midwest Rust Belt town. So it's not, yeah. So just wanted to compare the numbers, and so that's the reason I was thinking, I can also reach out to Jesse offline. What are the home prices going for? What the numbers will look
Hmm.
like, after considering everything with the interest rate and everything and other factors
Yeah.
like HOA and other stuff.
Right.
What the number would look like for me on a month-to-month basis.
Right. Right.
So that's
Well, and
yeah.
something I think for people coming from other states that I have to tell a lot is purchase prices here are definitely higher than most states. However, our property tax is a lot lower. So you see, I don't know about Michigan,
Hmm.
honestly, but you look at places like Texas.
Michigan have higher property taxes, but Michigan